Did you know the IRS has quietly rolled out a game-changing rule that could hand seniors over 65 up to $12,000 in extra tax breaks, potentially saving you thousands in cold hard cash? But shockingly, the vast majority of retirees haven't even heard about it yet. And if you ignore this, you might as well be lighting money on fire during your golden years. If you're tuning in and this hidden gem could supercharge your retirement savings, do me a favor and hit that subscribe button right now to never miss out on more insider tips like this. And drop a comment below with your biggest tax headache so I can cover it in a future video. Your input keeps this channel rolling. All right, let's dive straight into this bombshell without wasting a second, because what we're unpacking here is a fresh IRS provision that's already on the books and ready to transform how folks in their later years handle their finances, especially over the next 4 crucial years leading up to 2028. Imagine this, you're finally enjoying retirement, but those pesky taxes keep nibbling away at your nest egg. Well, hold on to your hats because yes, there's absolutely a brand new avenue for older Americans to slash their tax bills significantly. And it's not some minor adjustment buried in fine print. This is a substantial overhaul in how the government assesses your earnings, one that could keep hefty sums right where they belong, in your bank account instead of Uncle Sam's coffers. To put it in perspective, we're talking about a possible $12,000 windfall deduction for married couples both aged 65 or above filing jointly, or a solid $6,000 for singles in that age group. Numbers that aren't hype, but genuine opportunities to shield more of your hard-earned income from taxation. This isn't a fleeting loophole or shady scheme, it's legitimate relief aimed at easing the burden on retirees facing rising costs everywhere, from groceries to healthcare. So what's the scoop on this innovative perk? Let's unpack it step by step, starting with the basics. Officially dubbed the Senior Bonus Deduction under the One Big Beautiful Bill Act, this is a time-limited extra write-off tailored exclusively for those 65 and up, enacted as part of a broader tax reform package to deliver targeted support to aging citizens grappling with fixed incomes in an inflationary world. What sets this apart and makes it a true powerhouse is its ability to layer on top of what you already qualify for. Think of it like stacking pancakes at your favorite diner. You start with the standard deduction as your base, slap on the existing over 65 bump, and then crown it with this hefty new bonus, creating a towering shield against taxes that far exceeds what was possible before. This compounding magic is why the overall impact can be so profound, allowing you to protect a much larger chunk of your retirement funds from the IRS's grasp. Now, to make this tangible, let's crunch some real-world numbers and see how this plays out for everyday scenarios, because understanding the dollars involved is where the excitement really builds. Take a solo filer aged 65 or older gearing up for the 2025 tax season. The projected standard deduction sits around $15,750, plus that long-standing $2,000 add-on for your age. And now tack on the fresh $6,000 bonus, totaling a whopping $23,750 off the top before taxes kick in. That's nearly $24,000 of income vanishing from the taxable equation, meaning you could owe zilch on that amount, freeing up cash for travel, grandkids' gifts, or just bolstering your emergency fund. But wait, it gets even more impressive for couples. If both spouses are over 65 and filing together, begin with the joint standard of about $29,200, add $3,200 for the dual age extras, and layer in the $12,000 bonus. Boom! You're safeguarding over $44,400, a figure so substantial it could cover a year's worth of living expenses for many or fund that dream cruise you've been postponing. Picture this in action. Say you're a retired teacher pulling in Social Security plus a modest pension. Without this, taxes might eat into 15% of your benefits, but with the stacked deductions, you could drop your effective rate dramatically, perhaps even to zero if your total income hovers in the lower brackets. And here's a key twist that broadens its appeal. This bonus isn't picky about your deduction style.
Whether you're the type who itemizes every medical bill, charitable donation, and property tax to maximize savings, or you prefer the no-fuss standard route to keep filing simple, this add-on applies across the board, a flexibility that's rare in the tax world and makes it accessible to virtually everyone qualifying. Of course, nothing from the government comes without caveats, so let's navigate the eligibility hurdles and timelines to ensure you're positioned to grab every penny. First off, this isn't a forever deal. It's strictly for tax years 2025 through 2028, a narrow 4-year span that demands proactive planning. Because come 2029, unless lawmakers extend it amid political pressures or economic shifts, it'll evaporate like morning dew. So treat this as a limited time offer and adjust your financial moves accordingly, maybe by deferring income into these years or ramping up Roth conversions outside this window. Income thresholds are another critical gatekeeper, crafted to prioritize those with moderate earnings. For singles, the full bonus starts phasing out at $75,000 adjusted gross income and vanishes entirely at $175,000, while joint filers see it taper from $150,000 up to a complete cutoff at $250,000. Think of it as a sliding scale, where higher earners get partial relief, but the sweet spot is for middle-class retirees. How does the phase-out tick? It's straightforward math. For each $1,000 over the starting limit, your bonus shrinks by $60. So if you're a single at $85,000, that's $10,000 over, equaling a $600 reduction, leaving you with $5,400 still, a decent haul that underscores why even borderline cases should run the numbers rather than assuming they're out. To illustrate, consider a hypothetical couple, John and Mary, both 67, with combined pensions and investments yielding $140,000 annually. They'd snag the full $12,000, potentially dropping their tax liability by $2,640 at a 22% bracket, money that could offset rising utility bills or fund home modifications for aging in place. On the flip side, if their income creeps to $160,000, the phase-out kicks in at $150,000. So $10,000 excess means $600 less, but $11,400 remains a win. Now, claiming this isn't rocket science, but it requires deliberate action since it's not automatic. Kick off by using Form 1040-SR when filing in early 2026 for 2025 taxes, that senior-friendly version with bigger fonts and streamlined guidance. Check the Age 65 box to activate the perks, then fill out the new Schedule 1A to compute your exact bonus, plugging in income details to handle any phase-outs seamlessly. If you're tech-savvy, most tax software like TurboTax or H&R Block will guide you through this effortlessly, auto-populating fields and flagging eligibility. But if you prefer a pro, consult a certified accountant to avoid slip-ups, especially if your situation involves complex elements like rental properties or stock sales. One massive myth floating around that I need to debunk head-on is the notion that this wipes out all taxes on Social Security. Sorry, that's not accurate. The taxation rules for benefits remain unchanged, where up to 85% can be taxable based on combined income formulas. But by slashing your overall taxable base, this deduction indirectly lessens the hit, possibly pushing more of your benefits into the tax-free zone. For instance, if your provisional income, half Social Security plus other earnings, was borderline taxable before, this could tip it under the thresholds, say $25,000 to $34,000 single, resulting in zero or minimal tax on benefits, a ripple effect that's golden for low to moderate earners aiming for a zero tax return. Zooming out, why does this matter beyond the spreadsheets? In an era where inflation erodes purchasing power and healthcare costs skyrocket, think average Medicare premiums climbing 5% yearly, this deduction isn't mere paperwork, it's a lifeline, translating to real-world relief like covering a $1,320 tax savings in the 22% bracket from that $6,000 single bonus, enough to handle co-pays, stock up on essentials, or even splurge on family dinners without guilt. For part-timers still working a few shifts at the local store, no worries. It applies regardless, as long as income stays within bounds, blending seamlessly with earned wages.
Key reminders. Age 65 by year's end is the entry ticket. It meshes with both deduction methods. Mind the phase-outs to forecast accurately, and above all, its temporary nature means strategizing now, perhaps accelerate income into post-2028 or minimize withdrawals from IRAs during this period to maximize the shield. Don't overlook state taxes either. While this is federal, some states conform to IRS rules, potentially amplifying savings, so check your locale's revenue department for bonuses. Expanding on planning, savvy seniors might rethink Roth IRA contributions or conversions outside this window, since traditional IRA deductions could pair nicely here. Or consider bunching charitable gifts in off years to itemize maximally when the bonus lapses. Another angle, if you're nearing 65, time major financial decisions around your birthday, say delaying a home sale to qualify in 2025. For widows or widowers, filing status shifts matter. Qualifying widower gets joint-like benefits, so verify. Health savings accounts, HSAs, dovetail well too, as pre-tax contributions further lower AGI, preserving more of the bonus amid phase-outs. Let's weave in a real-life vignette. Meet Sarah, a 68-year-old widow in Florida with $60,000 from Social Security and annuities. Pre-bonus, her deductions totaled $17,750, leaving some benefits taxable. But now, at $23,750, her effective tax drops to near zero, saving $800 annually, funds redirected to hurricane-proofing her home. Or take the Browns, a Texas couple at $120,000 combined. Full $44,400 deduction shaves $9,768 off taxes at 22%, enough for an RV road trip. These stories highlight the human impact, turning abstract policy into empowered retirements. But vigilance is key against pitfalls. Scammers are already circling, peddling phony claim services for fees. Steer clear, as IRS resources are free via irs.gov, with tools like the interactive tax assistant demystifying eligibility. Avoid guaranteed refund pitches. Legitimate help comes from VITA programs or enrolled agents. If audited, keep records like birth certificates proving age and income docs. For expats, this applies if filing U.S. returns, but coordinate with treaties. Business owners over 65. If self-employed, this offsets Schedule C income, potentially lowering self-employment tax indirectly. Investors use it to harvest losses more aggressively, as lower AGI eases capital gains packets. Philanthropists pair with QCDs from IRAs for tax-free giving up to $105,000 in 2025, stacking efficiencies. Caregivers, if supporting elderly parents, advise them on this while exploring dependent credits separately. In multicultural families, translate IRS pubs for non-English speakers. Tech tools, apps like Mint track income to stay under phase-outs. Economic context, with Fed rates stabilizing, this aids fixed income folks against bond yield dips. Policy wonks note it's from bipartisan efforts addressing longevity, where Americans live longer but save less. Critics argue phase-outs exclude wealthier seniors, but proponents hail middle-class focus. Future extensions? Lobby via AARP if valued. Bottom line, this 4-year boon demands action. Review 2024 returns as baseline, project 2025 income, adjust withholdings via W4P for pensions to avoid surprises. Consult pros if divorced, with alimony factoring into AGI. For veterans, VA benefits aren't income, preserving eligibility. Disabled seniors, if blind, extra $2,000 stacks too, per rules. Eco-conscious, deduct energy-efficient upgrades via credits, compounding savings. Travel buffs, use windfalls for senior discounts on trips. Foodies, offset grocery inflation. Bookworms, fund library donations. Grandparents, spoil kids tax smarter. Ultimately, this empowers choice. Spend, save, or give with less tax drag. So, as this window narrows, what's your strategy to squeeze every drop? Maybe cut discretionary spending to dip under phase-outs, or work gig economy jobs strategically. Perhaps relocate to no-tax states like Nevada for double wins, or invest in munis for tax-free interest, keeping AGI low. The clock's ticking. Act wisely, claim boldly, and thrive in retirement.